In section 15-3, we have another adjusting entry, which is for depreciation. So we're going to talk about depreciation and then do an adjusting entry. So it's important to know that assets are broken up into two different categories. So remember, assets are value to the company. So cash, supplies, prepaid insurance, those would all be assets that have value, and they'd be considered current assets because you're going to use them within a year. Plant assets, on the other hand, are physical assets such as vehicles, machinery, even things such as printers. Things that you will use for a number of years are called plant assets. So those plant assets, you use them for a number of years, but the value of them decreases, and that is called depreciation, when the value of something decreases over time. So we are going to have a new account title called depreciation expense, because as the value of something we own decreases, that is an expense to the company. So in order to determine how much an item depreciates, we need to take into consideration the original cost of the item, the salvage value, which is the cost or the value of the item at the end of its usefulness, and then the useful life. How long can we use this item? So when we talk about original cost, pretty self-explanatory how much you pay for the item, but that also would include the delivery and installation of the item, which could be pretty expensive. Salvage value, that is the value at the end of the useful life. So when you're no longer able to use it anymore, does it still have a value? And that's possible. That could be something like, even if it's just a hunk of metal, there's still value for metal. So a piece of equipment still might have value, even just the value of the metal, even if it no longer runs. So this is just an estimation. You don't really know how much the value will be in 7 years, but you make an estimate when you purchase it. And then the useful life. This is also an estimate, and that would be the period of time that you would use that item, and it would have value to your company. So you have to make an estimate when you purchase it. Maybe you're going to be using it for 5 years and you'll buy a new one, maybe 7 years. It just depends. We are using the straight line method of depreciation. This means that every year, the amount of depreciation is going to be equal. So we will depreciate the item equally over the course of the useful life. So we have the original cost of the item minus the salvage value, which is, remember, the value at the end of the use of the item. So in total, this asset that started out being worth $70,000, by the time we're done using it, it's only going to be worth $10,000. And we want to make sure that our accounting is up to date as possible at the end of every year before we create our income statement and balance sheet. So we are going to depreciate that item by $60,000 over the useful life. So $60,000 divided by the amount of years that we're going to use it. Every year we need to decrease the value of that item by $10,000. So that way it is as accurate as possible. We don't want to show an asset for $70,000 when really the value of that asset may only be $10,000. Over time, every year we're going to add an additional $10,000. $10,000. So after 2 years of depreciating, we've already accumulated $20,000 of depreciation on that item. And this is important to know in order to calculate our book value. The book value is the value of that asset at a given time. So we know after 2 years, we depreciated that item by $20,000. So the book value after 2 years of owning that item is $50,000. And that's what we want to make sure that our accounting represents, the correct amount, which would be $50,000. So we need to do a journal entry. We're going to have 2 journal entries. We're going to have office equipment and store equipment. So we need to debit our expense, so depreciation expense dash either office or store equipment, and then accumulated depreciation is what we credit. So we are adding to that amount constantly as we accumulate depreciation. It's like a rolling balance of how much depreciation our company has had. So here is our transaction, debit depreciation expense, and credit accumulated depreciation. Those values are for multiple items. So we may have 7 different office equipment, plant assets that we depreciate every year. Store equipment, you could have cash registers, security cameras. So we have it broken down between office and store equipment, and that may include multiple items. And that is our depreciation adjusting entry to make sure that our assets are valued at their actual value at that time.